Hello and welcome to Sectors Up Close. I'm Ramzan Karmali. Today we're going to talk about banks on this side of the Atlantic with Russ Mould, Investment Director at AJ Bell. US bank earnings are already underway. JP Morgan and Wells Fargo both booked earnings that beat forecasts as the US economy keeps powering along. Here, UK banks, including Barclays and global giant HSBC, start reporting next week in an economy that suffered a shallow recession last year and where interest rates don't look like they'll move lower as rapidly as they will do in Europe and the US. But their share prices have been on a roll this year, up about 20%, as measured by the FTSE 350 UK Banks Index. But despite those gains, they're still much cheaper relative to their US peers, as measured by both price to earnings and price to book value. So why the gap? And what's the outlook for those who hold these stocks? Well, let's ask AJ Bell's Russ Mould. Russ, thanks so much for joining us. Well, I noticed UBS put out a note today saying that UK banks are undervalued partly due to the fact there's a bit of uncertainty around what will happen to taxes under Rachel Reeves and her new budget, which is due later this month. Do you agree with that?
I think everybody is looking towards the 30th of October with some degree of trepidation. Remember when Tony Blair's Labour government got in 1997 with a massive landslide, they very quickly put some windfall taxes on utilities. And we have a government here which is looking to raise revenue, looking to generate income for investment. And so you could argue that banks may be one area. They are making between them pretty much record profits. And again, they would be politically a pretty easy sell to the British public.
So does this make them a buying opportunity given their dividends as well?
I think, as General Colin Powell of the United States said, you have to make decisions with only 40 to 70% of the evidence. You wait to get till 100%, too late. So I think if you feel that there is value here, then the budget uncertainty will add to that. They are trading on, with the exception of Lloyd's, a discount to book value between 7 and 10 times earnings, and the domestic-facing banks are returning up to 10% of their market cap through dividends and buybacks this year, which I think overall income investors might find a relatively compelling proposition. I guess the only potential spanner in the works is either a buyback tax or sufficient windfall taxes to deter the banks from paying those buybacks.
Now, what about the idea of falling rates that we're heading for? Could that put a cap on their earnings going forward?
Yeah, analysts are expecting broadly flat aggregate pre-tax income from the big five FTSE 100 banks this year and next year, albeit, I should say, at pretty much record highs and figures well above the pre-financial crisis peak of 2007. Net interest income peaked at £20 billion across the five nearly 2 years ago. It was just under 17 billion in the last quarter. It is clearly having an effect. That said, you would like to think that lower rates would help the economy, which would help loan impairments and keep those to a minimum. So there should be a bit of a balancing act as far as the earnings are concerned. But you're broadly flat profits expected, but again at record highs.
Russ, let's look at the Asia-focused banks now. Standard Chartered and HSBC. How tied in are they to how well China does? And what about the recent measures that have been announced? Do you think that will support their shares going forward?
I mean, Hong Kong and China are huge earners for both banks, which is probably why they've lagged the UK domestic ones in the FTSE 100 this year, which isn't something you would have necessarily expected. And it certainly explains, I think, why Standard Chartered trades at barely 2/3 of book value and is about the cheapest of all the FTSE 100 banks. So if you did get market sentiment really turning on China and Hong Kong and there being growing faith in their economic outlook, yeah, you'd expect that to be helpful for both of them.
Now, looking here at Barclays, the shares are up around 50% so far this year. Earnings from the investment banking division are clearly outperforming weakness in retail and corporate. Is now a good time to buy? Are they undervalued, these shares?
Well, I mean, it's still the second cheapest bank of the FTSE 100's big five on book value, so I'm not sure the market's thoroughly convinced the turnaround is there. And I think it would still like to see a sustained run of profits from the investment bank, because historically it's been very volatile. If you think the UK economy is going to stay out of recession, the UK equity market will finally get some love and go on a bit of a sustained run and see some primary and secondary issuance, Barclays would be a big leverage play on that. Only 11 billion of issuance this year, primary, secondary in the UK. It would be in pole position to grab a slice of anything else that comes your way. So if you're a relative optimist, Barclays is probably of great interest to you. If you're a pessimist, probably not so much.
Now, looking at Europe, and there's a lot of M&A talk, the likes of BBVA are going after Sabadell, with Commerzbank and the UniCredit sort of merger in the pipeline as well. Do you think that could affect valuations here?
I think it reflects valuations certainly across Europe. Again, Commerzbank, you could argue for very good reasons, looks very cheap on book value. The same about you could say for the Spaniards. Europe, as we know, the banking industry is very fragmented. There's probably more competition there than there is here in the UK. So the valuations may, in some select cases, be lower. But again, it perhaps makes the value case for financials more widely if there is a wave of M&A and there is further consolidation to come.
Russ Mould from AJ Bell, as always, many thanks for your thoughts. And that is your roundup of the UK bank sector. I'm Ramzan Karmali, and this is Reuters.